Remember the government funding drama of last summer and fall? The United States government had run up against the debt ceiling, and we were all told that catastrophe was going to descend upon us if the debt ceiling wasn't raised immediately. For those of you a little fuzzy on the matter, Investopedia defines the debt ceiling, also known as the debt limit, as the maximum amount of money that the United States can borrow cumulatively to meet its existing legal obligations. So basically, in addition to the budget, whether or not we spend more than we have taken in taxes, there is a cap on the total amount of debt that the United States can have at any given time. And throughout history, in fact, repeatedly over the last years, that debt ceiling has been raised immediately. In the summer of 2023, we were coming up against that debt ceiling again. And how did we handle it this time? Well, as pbsnews.org or pbs.org reports, on June 3rd of 2023, Biden signs bipartisan bill that suspends debt limit until 2025, cuts spending. With just 2 days to spare, President Joe Biden signed legislation on Saturday that lifts the nation's debt ceiling, averting unprecedented default on the federal government's debt. Laughably, the spending cuts obviously didn't materialize, but what else have we seen happen with the government's quote-unquote temporary ability to borrow unlimited money? I find it extremely ironic that many of the people who were outraged that Congress hadn't raised the debt limit yet, or that there was a limit at all for that matter, are also among those now currently outraged that in less than a year since the spending limit was completely suspended, at least temporarily, Congress had borrowed hundreds of billions of dollars to fund wars that are going on in two very specific countries. This is an excellent example of fiat-enabling wars that were trickier to finance when you had to actually tax the people to wage them, and therefore it was a little bit harder to fight battles that weren't so popular.
This podcast is for information and entertainment purposes only. Nothing on this podcast should be construed as financial advice. All views expressed on this podcast are solely the opinions of the host and/or any guests that we might have from time to time. Nothing on this podcast should be construed as a specific inducement to make a particular investment or to follow a particular investing strategy.
Hello, Sat Stackers, and welcome to the latest episode of the Bitcoin Bulletin Podcast. Today is Wednesday, May 29th, 2024, and of course that means it is DCA Wednesday once again. We have a lot to talk about. I'm not really going to get into the wars. I think the introduction pretty much described how I felt about fiat enabling war and about fiat enabling government spending in general in the introduction. And there's a lot to cover beside that anyway. Before we get into all that, however, let's take a quick look at the vital statistics. At the time of this recording, we find ourselves at a block height of 845,718, and Bitcoin is ringing in at a US dollar value of 67,530 US dollars. That is just about almost exactly $2,000 cheaper than last DCA Wednesday, but still more than $1,000 more, $1,500 more than two DCA Wednesdays ago, and more than $6,000 more than three DCA Wednesdays ago, darn near $10,000 more than we started the month with the very first DCA Wednesday on May 1st. So all of that, obviously, I remind you to zoom out and keep into perspective. The good thing, however, is that we are going to receive 1,481 sats per dollar for every dollar that we convert into Bitcoin. And that is significantly more than the 1,439 sats per dollar that we received last week. 40 or 50 sats per dollar might not seem like a lot, but I remind you, one day we're going to be on dollar sat parity, or maybe even higher. And and every sat that we stack in the meantime, at least before hyper Bitcoinization, will make a difference. So for those of you out there who are worried that your stack isn't big enough, we're going to be able to stack a few more sats than we were just last week. The current block puts us just 204,282 blocks away from the next halving. I kind of jokingly cite that statistic again because we just had the last halving just about a month ago. But for those of you who don't know, the Bitcoin Core protocol cuts the reward that miners receive for finding a block in half every 210,000 blocks. That just happened at block 840,000 and will occur again at block 1,050,000, which looks like it will occur sometime in March of 2028. But in the meantime, we are just beginning what many of us believe will be the most current 4-year cycle, where we see, Bitcoin go off on yet another face-melting bull run, eclipse previous all-time highs, set blistering new all-time highs, and then, of course, retrace before we have a consolidation period of a year or two, and it all begins again. Bitcoin's current price gives it a market capitalization of 133 trillion. I'm getting a little ahead of myself. 133 trillion. Oh, that'd be amazing. $1.33 trillion. That's still higher than silver's $1.32 trillion market cap, which was a significant milestone that we eclipsed. We eclipsed a couple of times. We've seesawed up and below silver as far as the rankings of currencies by market cap. But again, still significantly below gold's market cap of about $14 trillion. So that just shows you that we are still early and how far Bitcoin has yet to go. If Bitcoin does become the global reserve currency, if we achieve Bitcoin hyper-Bitcoinization, or even if Bitcoin just becomes the digital version of gold, becomes on par with gold, doesn't even have to surpass it. We have a long way to go still to achieve a market cap of more than $14 trillion. For those of you who value your wealth in those shiny yellow rocks, 1 Bitcoin will currently cost you 28.9 ounces of gold, just a little cheaper in gold terms than last DCA Wednesday. Obviously, the price of Bitcoin has trended down a bit, but apparently so has gold, because we're almost on par with where we were last week at 29 ounces of gold to purchase just 1 Bitcoin. And of course, as I remind you, gold continues, if you zoom out, to trend to zero in Bitcoin terms. It wasn't that long ago that, Bitcoin became on par with just 1 ounce of gold, for example. If you zoom out, if you set a long enough time horizon. And as I predicted multiple times, or as I continue to predict, and I've been predicting for months now, by the end of this year, we'll be referring to the cost of Bitcoin and gold in terms of pounds of gold, not ounces, as we go on to eclipse and set new all-time highs this looming halving bull run. Forgive me, I'm a little tongue twisted today. It's been a long weekend. I'm a little tired this evening. Still excited, still jazzed to get our stack on. But if I trip up, if I'm a little more tongue-tied than usual, it's been a long weekend, and I'll get into that in a little bit. But I digress. Of course, last DCA Wednesday was the 14th anniversary of Bitcoin Pizza Day, and along those lines, for those of you who value your wealth in pizza, 1 Bitcoin will currently purchase you 3,776 large pepperoni pizzas from Papa John's. That is 1 pizza a day every day for more than 10 years. And again, I firmly believe that if you tried to spend 1 full Bitcoin on pizza, and you did so ordering 1 pizza a day, you'd never actually spend that Bitcoin, because, as I said, we're just beginning the new halving cycle. We have yet, even though we've already set a new all-time high or eclipsed our previous all-time high, that technically was before this halving cycle that happened before the halving. And of course, many people consider that not necessarily a fluke, but basically because of the hype around the Bitcoin ETFs. Either way, if history rhymes or repeats, we shouldn't even begin to be seeing new all-time highs until, this fall, maybe November or December. Adam Meister had a great 1 Bitcoin show yesterday, I think it was, where he got into that a little bit. He's at TechBalt on Twitter, if you're not already following Adam Meister. He's kind of stepped back from his podcasts and now only does them if people pay him to do so. Back in the day, he did a 1 Bitcoin show every single day. And then, of course, on Fridays, he had his This Week in Bitcoin show, which was kind of like his 1 Bitcoin show, but he also had guests on. But I digress. Continuing on, looking at Clark Moody's dashboard, he is reporting that the Bitcoin mempool, his mempool, has 156,444 transactions pending. And that is down from last week when they were reporting 174,216 transactions. Mempool.space, however, completely disagrees with Clark Moody's mempool. They're showing 221,258 transactions pending in the mempool, which is up from last week where they were showing 205,735 transactions pending in the mempool. Either way, there is a lot of on-chain activity going on out there. Clark Moody no longer calculates the number of blocks to clear. He was pretty much shamed into enlarging his mempool and removing that metric from his dashboard by Marty Bent and Matt Odell on their Rabbit Hole Recap podcast. Although they did backpedal a little bit on that after he did so, because they pointed out that it was brought to their attention that there are some problems with really, really large mempools, because if you have a huge mempool and you have those transactions in your mempool and they drop out of other mempools, when those if you had a smaller mempool and that transaction were to have been dropped out, it would get rebroadcast around the network, and that by having that larger mempool, you don't rebroadcast those transactions when other mempools rebroadcast them. So they backpedal a little bit on that, ate a little bit of humble pie, I guess you could say, for teasing about how small his mempool was. Again, I'm getting off on a tangent. Along the lines of how busy the network currently is, if you have a transaction that you need to make on chain and you want to guarantee that it's included in the next transaction, Clark Moody's fee estimator is saying that you will need to pay a fee of 42 sats per VByte to guarantee that. That is almost triple last week, where he was recommending a fee of 15 sats per VByte to get in the next block. However, that's kind of a temporary situation, because his fee estimator is saying that if you have a day to wait, a fee of just 8 sats per VByte will be mined within 24 hours, and that is down from last week. And of course, they're holding with their fee estimate of 7 sats per VByte, eventually getting approved if you have a couple of days or up to a week to wait. Mempool.space is telling a slightly different story as usual. They're more consistent with what Clark Moody's dashboard was saying last week. They're recommending a fee of 16 sats per VByte for a high priority transaction. At current US dollar values, that works out to about $1.51 for a high priority transaction to be in the next block or two. And that is up a little bit from last week when they were recommending 13 sats per VByte. Along those lines, if you have a medium priority, a low priority, or a no priority transaction, they're still recommending a fee of 15 sats per VByte for that medium priority transaction, or a fee of 14 sats per VByte for a low priority transaction. And their lowest fee estimate is a 10 sat per VByte fee for a no priority transaction. So still not crazy expensive like we had seen several months ago, but definitely not the 1 sat per VByte fees that we were used to if we had a little bit of time to wait for a high priority transaction. Of course, none of that matters if you're using Lightning or second layer solutions, if you're not making on-chain transactions. And really $1.51 is still incredibly cheap to be able to send money anywhere in the world darn near instantly, and the ability to do so without any permission, without going through a bank, and to send a transaction that nobody can stop. All right, that metric, it's been my favorite metric for most of the history of this podcast. Bitcoin's 24-hour average transaction rate is absolutely soaring. At the moment, we're showing the transaction average of 8.47 transactions per second, and that certainly explains why Clark Moody is recommending a higher fee than he had been recommending for the last couple of weeks. That is absolutely zooming. That's actually up quite a bit. I'm not 100% certain we've actually seen it that high ever. We've seen as high as 7 transactions per second just a couple of weeks ago. And I think during the peak of the ordinals and transcriptions mania, we were still only in the 7 transaction, like 6.8, 6.9 transactions per second. So 6.847 transactions is a heck of a lot of activity. But it looks like that's also kind of a surge, not necessarily consistent high traffic volume. Either way, we've been consistently above the 4 transactions per second that we would have considered high transaction volume until Taproot came along and we had all the ordinals and inscription shenanigans, the stamps, the runes, etc. And speaking of on-chain, I guess it was just hours after the last Bitcoin Bulletin, our last DCA Wednesday episode, the difficulty that it takes to mine a block of Bitcoin had a upwards difficulty increase of 1.5%, which was actually even higher than we were looking at just 7 or 8 hours prior to that difficulty adjustment, it was looking like it was going to be, a 1.1% difficulty increase. So obviously network hash rate picked up, transactions picked up, even in the few hours that we had prior to that difficulty adjustment. Of course, a lot of that was probably because we've had a lot of hash rate turning on and off with the heat wave, especially in Texas, where a lot of the commercial mining hash rate is located. Either way, we're now exactly 1,002 blocks away from the next mining difficulty adjustment. That looks like that's going to be on next DCA Wednesday, June 5th. And as with the last difficulty adjustment, it's also going to be an increase in difficulty of anywhere between 2.83 or 3.9%. Of course, that remains to be seen because, again, I've mentioned that, the heat wave, the higher than normal temperatures have affected the mining operations in Texas, where they have agreements with the grid to scale their mining operations back to allow that energy to be sold back to the grid to alleviate energy shortages, brownouts, rolling brownouts, blackouts, etc. And even if that weren't the case, a lot of things can happen in a week. We're only halfway there. But currently, transactions are coming in at an average time of 9 minutes and 38 seconds, which is quite a bit faster than the 10 minutes between blocks that the protocol aims for, that it shoots for, and that is why we're looking at a difficulty increase. Throughout the entire history of Bitcoin, more often than not, we've been looking at difficulty increases, which is why you can no longer mine on your laptop anymore, why we went from laptop mining to GPU mining to ASIC mining to ever more powerful ASICs, because people keep adding more and more hash power to the network. The network hash power has been growing even faster than the Bitcoin price, for example. So in general, just like the Bitcoin price, if you zoom out, hash rate goes up and to the right, and therefore we should expect that on average, it's going to get more and more difficult to mine the next block of Bitcoin. None of that really matters to you unless you're mining at home or you're a large commercial miner, because if you're just a pleb trying to send a transaction, really the difference between the 9 minutes and 38 seconds that blocks are averaging in 10 minutes is negligible. And of course, since that's an average, you could get lucky and you could have the next block be mined a minute or two after you send your transaction, or you could, be unlucky and it could take an hour for that transaction to be mined. And hopefully you're not standing at a coffee shop waiting for that payment to go through before they hand you your cup of coffee, and that you're using Lightning instead, which is instantaneous and darn near free, or in the future, possibly even different second layer solutions that we'll get into a little bit in just a little bit later on in this podcast. All right, before I go any further, I want to take a minute to thank all of you listening on your favorite Podcasting 2.0 app. Podcasting 2.0 is a method that allows you to support your favorite podcast through the value for value model. In addition to that, by listening on Fountain, you can earn Satoshis just for listening to your favorite podcasts. But what I consider perhaps more importantly, you can help support your favorite podcast by contributing value based on how much value you feel you're getting from that podcast in one of two ways. Some people choose to stream Satoshis on a per minute basis. For example, if you think listening to this podcast gives you 1 Satoshi per minute worth of value, you can set that and stream Satoshis automatically. And that is really cool because I can see those sats coming in, and that's a neat feeling. However, my preferred method of value for value is the boosting method, where you can send a shout out to your favorite podcast in the form of a Lightning transaction, and that allows you to support your favorite podcast while sending a message. And we do have one of those boosts to read. Longtime supporter Leggy boosted 3,000 sats and says, "Epic rocket launch episode. Face melting and cheese melting made my day. I used the cheap fees to try some coin joins." Well, thank you, Leggy. Thank you as usual. That was a little bit surprising to have that SpaceX Falcon 9 rocket launch halfway through my podcast. It used to be I never missed a rocket launch. I was up to speed on when every launch was, and I at least went outside to watch, if not got as close as possible to the launch pad to watch. But, recently we've had several launches a week. Sometimes we've had 2 launches in the same day. Last week we had that rocket launch during the middle of the podcast, and then we had another one less than 24 hours later. And as SpaceX has started launching more and more rockets, particularly when they're their own missions, like the Starlink missions that those 2 missions were, they haven't been really good about publicizing those launches, oftentimes not letting us know there's going to be a launch until an hour or so beforehand. Obviously, it's a little bit more complicated than that to launch a rocket, so there are signs. For example, they let the Emergency Operations Center know there's going to be a rocket launch because emergency services have to be prepared in case something catastrophic happens. But you don't check in with the EOC constantly to find out, what they might be monitoring. So in this case, that rocket launch snuck up on me until the studio was absolutely rattling. And you could kind of hear it, despite the fact I was using noise canceling on the soundboard. You couldn't hear the rocket launch when I first noticed and first started talking about it. But particularly if you have headphones on, you could definitely hear the rocket launch during that episode. Of course, we also used the term face melting and cheese melting because it was pizza day and we were talking about the face melting bull run. And it's really cool that you tried out some coin joins, especially with governments around the world cracking down on Bitcoin privacy, cracking down on your ability to use coin joins or mixing, coin mixing. So thank you, Leggy, for that shout out. Thank you for that boost. Thank you for all of you who continue to listen on your favorite Podcasting 2.0 apps, because not only is it really cool that you help support the podcast, but when you do, I know who you are, and it helps me. I don't necessarily know exactly who you are. For example, Leggy is a pseudonym. It's a pseudonym, obviously, but it puts those NIMS faces with our listener statistics, and that's really cool. Speaking of our listeners, our geographic distribution of listeners had a little bit of a shakeup last week. It hasn't moved this week, but our top 10 countries by listenership are as follows. Number 1 remains the United States, where more than half of you are listening. So thank you to all my fellow Americans listening wherever you may be. It doesn't give me any more data about where in the United States you're listening. And obviously, the United States is a large, huge country. We take it for granted how big the United States is. But when I have friends visiting from other countries, they are just blown away at how long it takes just to drive across Florida, for example. Alaska and Texas are our 2 largest states, and it takes a notorious long time to drive across Texas. But if you drive up the coast of Florida and then across the Panhandle trying to get out of the state of Florida, I'm in the central part of Florida, north to south. You can go another 200 miles south of here before you run into the Keys. And even so, going from here to the Florida-Alabama line is over 500 miles. It takes, 8 hours or so just to drive out of the state of Florida. So the United States is a really, really large place. In 8 hours in other parts of the world, you could be in multiple countries. Of course, there are other countries that are gigantic as well, but I digress. Number 2 remains Argentina. So, hola, muchas gracias, amigos, in Argentina. Number 3 remains Germany. So, guten Abend, danke für alles, danke schön, mein Freund in Deutschland. Number 4 remains Canada. So, hello to you. I heard Canada. I heard a new term for Canada. Sometimes we jokingly refer to it as the frozen white north or America's attic. But someone referred to it yesterday or the day before. Someone referred to it this weekend as America's hat. I thought that was kind of amusing. But either way, hello and thank you to all of our friends in Canada listening today. Number 5 remains Luxembourg. So again, guten Abend or Morgen to those of you who speak Luxembourgish. Danke schön, mein Freund in Luxembourg. Number 6 remains Spain. So hola, muchas gracias, amigos in Spain. Number 7 remains the United Kingdom. So hello to our friends and cousins across the pond in the UK. Number 8 remains Venezuela. Hola, muchas gracias, amigos in Venezuela. Number 9 remains Colombia. Hola, muchas gracias, amigos in Colombia. And number 10 remains Mexico. Again, hola, muchas gracias, amigos in Mexico. Really cool that we have so many Spanish-speaking listeners or listeners from Spanish-speaking countries. Obviously, you speak English most likely if you're listening to this podcast because this is an English language podcast. I have guesses as to why we have so many listeners from Spanish language countries, but I honestly don't know, but it is really cool. I do enjoy my time in Mexico and South and Central America. I look forward to visiting El Salvador one day. I've never been there, but that would be really cool. I had friends that used to live in Colombia. I missed my opportunity to freeload off of them and go visit, but Colombia is certainly one of those countries I've always wanted to visit. Argentina has been on my bucket list for the longest time. Buenos Aires, I hear, is just an absolutely beautiful country, and it's uplifting and heartening to hear that maybe there's some additional hope in improving the economy and improving the the lives of everyday Argentinians. So that is cool. Of course, I've been to Germany. I've been to Canada. I've never been to the United Kingdom. Man, I need to get out more often. As you get older, it gets harder and harder to travel. I have a family member in Japan right now, and and they've traveled quite a bit recently. In fact, they were in the United Kingdom just a month or two ago, and they have other travel coming up in the near future as well. And I think it's really, really important to travel and see as much of the world as you can when you're younger, because when you get older, when you have more of an established career, sometimes it gets harder to take that time off. Of course, when you have young kids, it's harder to travel just because it's harder to travel with kids. And even when they get older and they travel a little more easily, you have less money, especially when they get older and you're paying for, sports, or you're paying for college, or you're paying for car insurance, or whatever it is. Children can be expensive. Obviously, it's worth it. And there's many, many rewards for having children. I'm not complaining. I'm just saying it's more expensive to take a family of 4 on a European vacation than it is to go by yourself and stay in a hostel, when you're younger. So I encourage them to travel as much as possible while they're still young. And I encourage all of you to do so if you have not. I certainly wish I had traveled more. I look forward to traveling more one day. All of my bucket list goals seem to revolve around traveling. Of course, I've mentioned that I follow a lot of Germans on Twitter, and I have friends in Germany, and it seems like Germany has just a lot of fun Bitcoin meetups. We have huge Bitcoin meetups like the one that's getting ready to happen in Prague, but little Bitcoin meetups where it might even be 5 or 10 plebs getting together and doing something fun or something crazy at some castle or at some beer hall, and it just looks like European Bitcoiners and German Bitcoin plebs have so much fun that in addition to my bucket list involving travel now as a Bitcoiner, my bucket lists involve traveling and getting to go meet Bitcoiners, getting to go to attend some of these Bitcoin meetups. I really, really want to stay at the Hotel Princess Plochingen. I have a hard time pronouncing that, even though I speak a little bit of German, not as much as I used to. Ein bisschen, as they say. Once again, I'm getting off on a tangent. So let's get on with the news. As I've mentioned many, many times, we're living through what reminds me a lot of the 1970s. I've mentioned that we're having very similar, if more extreme, we have a very similar, if more extreme administration. That I think the biggest difference between Joe Biden and Jimmy Carter, who was president for a lot of the 70s, a lot of the time when we had stagflation in the 70s, when inflation was a problem, when we had trouble in the Middle East, when oil was expensive, when inflation was going through the roof and homes became unaffordable. The biggest difference between Jimmy Carter, who was president then, and Joe Biden, who's president today, is that Jimmy Carter was at least basically a really nice guy. I mention this because I took a road trip to Columbus, Georgia over Memorial Day to visit the National Infantry Museum at what until recently was called Fort Benning, Georgia. They recently renamed it to Fort Moore because, well, that's what leftists do. We have a leftist president, and all throughout history, it seems that leftists are tearing down statues and renaming things in an attempt to rewrite history or to even erase history. And it's quite funny because the current administration has been eager to accuse locals, mom and pops, plebs, local school board members of book banning, for not wanting to have pornography in their kindergarten classrooms and their children's classrooms, when in fact leftists have banned the most books that I'm aware of, at least recently. I mean, for example, they've banned almost all of the classic American literature because by definition, most classics are really, really old. And in the United States, a long time ago, certain things were said or certain things were done that were offensive or flat out hate crimes, flat out illegal now. I don't think the books, Tom Sawyer, Huckleberry Finn or whatever, were particularly egregious books, but they were books that were written in the time they were written. And so there's an offensive word that appears in Tom Sawyer because it was a word that was used. But as a result, good luck finding a copy of Tom Sawyer. Or for that matter, good luck finding a picture book, a children's book, a Dr. Seuss book, if you don't believe that the American left has banned their fair share of books. Anyway, another tangent. I'm probably pretty infamous amongst our listeners for my tangents. But anyway, on the way to Columbus, we drove past the Jimmy Carter historic sites, where he grew up, where his infamous peanut farm was, because if you don't know, Jimmy Carter was a peanut farmer before he was governor of Georgia, before he became president of the United States. And it caused me to reflect on this because I still had an hour or so left to drive. And anyway, my point being, it is striking at just how much history seems to be repeating itself here. Anyway, along those lines, the economy continues to be in the news, continues to be a major part of what we are talking about in the news today. We've been repeatedly, perhaps insultingly, told by our current administration that despite inflation, we're living through the best economy in 50 years, that there's the most jobs, that the economy is booming, we've got the most economic growth, etc. Of course, they also lie to us about how bad inflation has been and continues to be. Nonetheless, this is one issue they have a really hard time gaslighting even the dumbest normies, because everyone has to go to the store. You have to buy groceries, you have to fill up your car, you have to pay bills. Everyone has seen the dollar menu evaporate at McDonald's. Everywhere you look, there are signs that things are not as rosy as we're being told. One of those is a headline in Fox Business that states the average age of U.S. cars, trucks, hits new record amid high prices for new vehicles. The article states the average age of cars and light trucks on the road today in the United States has hit a new record of 12.6 years in 2024 as new vehicle prices remain high, according to vehicle registration data tracked by S&P Global Mobility. 12.6 years is pretty old. My first car was considered really, really old when I got it. It broke down all the time. I was doing maintenance on it every weekend, if not more often, if something like an alternator went out, or, it was old enough. It didn't have electronic ignition. It had a distributor. And it was only 11 years old when I got it. So 12 and a half years, that's pretty old. And the point being, more people are keeping their cars because people are hurting. The administration, governments around the world are telling us that GDP is booming, but the dirty little secret is GDP is booming in the United States for two reasons. It's booming because we have wide open borders and people are pouring into this country, population is expanding, and since GDP only measures the amount of money that's spent, the more people you have spending money, GDP is going to increase. Obviously, as inflation increases and the cost of goods increase, people are spending more money. They're going into debt to buy groceries, as we reported, that they're financing groceries. They're using services, buy now, pay later services that people used to get scammed into using to just buy refrigerators or furniture, things like that, just to purchase groceries and basic necessities. And this is not a sign of a healthy economy, but it does increase GDP. And so it gives them this statistic to say, look, the economy is better than it's ever been. The greatest economy in modern history. But all around us, there's signs. Like, for example, you're probably driving an older car than you used to be. You don't have the new car that you might have had or you might have wanted, had the economy truly been better. If the average new car was still closer to $15,000 like it used to be just a few years ago and not $45,000 that it currently is. And this is all related to Bitcoin tangentially because, of course, Bitcoin doesn't allow the governments to spend money they don't have. It doesn't allow governments to print money and to cause inflation. So, and that's why it is important. Furthermore, Yahoo Finance reported just yesterday, data reveals rising economic distress across America despite post-pandemic growth. We keep being told that when we had the pandemic and we had the lockdowns and we had governments ordered closed, obviously GDP took a huge hit because people were out of work. And then by just simply allowing those businesses to open again, we just went back to normal. Actually, we didn't even get back to normal. We were still lower than pre-pandemic. But the government patted themselves on the back and took credit for record economic growth just by taking the stores and the restaurants that they had shut down and allowing them to reopen. But that's besides the point. This article, and just the article goes on to say, a striking disconnect remains in the U.S. economy, continued growth and softening inflation, along with America's pervasive pessimism and uncertainty about the future. I think people are just uncertain, President Biden recently told Yahoo Finance in an exclusive interview, and that's why we've got to be steady, stay the course, and continue to produce these incredible jobs. Of course, what he doesn't mention is that most of these jobs are jobs that are created because we have an increase in the number of people in the United States, and because we have senior citizens, those 65 and older, having to go back to work to be able to afford to survive. We have people that used to have really great jobs working for tech companies that got laid off that now work at Walmart and maybe have to take up a second job bussing tables at a restaurant to make ends meet. So instead of having one really nice job, they have two crappy jobs. But the Biden administration wants to tell you, look at this incredible job growth. We now have two jobs where we used to have one. The article continues. Insight into the disconnect arises from a deeper look into the lifeblood of the U.S. economy, the states, cities, and towns that make it run. Data from the Economic Innovation Group's Distressed Community Index shows that as of 2023, local economies across America still hadn't fully recovered from the effects of the COVID-19 pandemic. According to EIG, which uses the U.S. Census Bureau data to sort districts by economic well-being, roughly 52 million Americans live in distressed zip codes. That's up from 50 million in 2018. So we've gone backwards. We now have an extra 2 million Americans living in distressed zip codes, despite the fact we have this soaring economy, the best economy in 50 years, or as this article says, incredible jobs. So, of course, we have blatant gaslighting in this article, along with the usual, this isn't the government's fault routine. Obviously, it's the pandemic's fault, which to some extent it was, or at least the lockdowns, the government mandated lockdowns. So it wasn't necessarily the virus, it was the government's reaction that did really kick the economy in the jimmy, so to speak. So even though the article clearly illustrates that things are in fact worse today than they were, they go on to say that there's a disconnect. Things are freaking fantastic, but the average American is in misery. So the gaslighting continues. But if you read between the lines, you can get yet another hint that the economy really sucks, even though you're being told it's fantastic. Fox Business reported today another sign that the economy isn't quite as rosy as we're being told. With the headline, ex-fast food CEO predicts more restaurants will close nationwide over high prices. The former Carl's Jr. Hardee's leader says he would not work in the industry today. With franchise and restaurant owners confronting a delicate balancing act between higher menu prices and labor costs, one former industry leader is concerned more doors are preparing to close nationwide. Quote, there will be a lot of restaurants underperforming. Middle-performing restaurants are going to go away. Very good performing restaurants will become Midland to low performing restaurants, former CKE restaurant CEO, parent of Carl's Jr. and Hardee's, Andy Pudster said on Tuesday on Varney and Company. As more restaurants close, there will be more customers for fewer restaurants, he continued, but people just can't afford these prices, and there's only so much you can do to reduce prices. Obviously, we've all seen the dollar menus evaporate. We all remember the $5 foot-long commercials from Subway that are now the $8.60 footlongs. We remember the $6.50 chicken burritos at Chipotle last year that are now $10.50 chicken burritos or burrito bowls. By the way, last time I checked, going from $5 to $8 or from $6.50 to $10.50 is more than 3% inflation, even more than the 6% inflation they admit to at the peak. But I digress. A little bit more doom and gloom from Fox Business when they wrote last week, JP Morgan warns S&P 500 could tumble 20% by the end of the year. The U.S. stock market soared to a new record high over the past week, but there may still be trouble on the horizon, according to JP Morgan analysts. The forecast from JP Morgan's chief marketing strategist, Marko Kolatovic, is one of the most pessimistic on Wall Street. He and his peers see the S&P 500 ending the year at 4,200, the lowest year-end target among major Wall Street banks. From current levels, that implies a more than 21% drop. They go on to quote him saying, with very high equity valuations, we do not see equities as attractive investments at the moment, and we don't see a reason to change our stance, Kolanovic wrote in an analyst note this week. My words now. Of course, we all know JP Morgan is no friend of the pleb, and they've said blatantly wrong things in the past. But it doesn't take a PhD in statistics to notice things like price-to-earnings ratios and to realize that stocks are way overvalued. When I first started investing, well before Bitcoin came along, I wouldn't buy anything that had a price-to-earning ratio of more than 3 to 5. Now, most people consider 15 or 20 as a fantastic price to earning ratio. And there's plenty of companies out there with 50 or higher price to earning ratios. Price to earning ratios means that if you took the earnings that the company had, that company would have to earn those earnings for X number of years just to match the stock price. And that's just nuts, because if you weren't just investing to try and get away from inflation, to try and keep your money from being devalued, you wouldn't invest in a company that its only value was based on the fact that people were pumping money into it. You'd invest into a company where you would get a return based on the fact that the company is making profits and that the company is going to increase its value by making those profits. Things that don't apply with such terrible price to earning ratios. I do see a way, and of course this isn't a stock show and I'm not a financial advisor, this is not financial advice, but I do see a way that stocks avoid the quote unquote collapse, and that is because where there has been hyperinflation, the cost of everything goes to the roof, and that has included stock prices. I mean, it seems to make sense, right? Inflation is the currency becoming worth less, so it takes more of that currency to buy any particular good. And remember, everyone leading up to the economic collapse of Weimar Germany thought they were getting absolutely rich off the stock market. All the accounts of Weimar Germany, they talk about how they're all going to retire next year because they're just making a killing in the stock markets. And of course, the best performing stock markets in the world have always been in the places experiencing hyperinflation. The thing is, you just aren't really turning a profit. Your money is worth less, and that's the only reason the stocks are costing more. Of course, these are also things that Bitcoin fixes. So enough with the gloom and doom. All right, well, something that sounds like gloom and doom, but it's another one of those cases of, once again, Bitcoin fixes this. Last week, Reuters reported the headline, Texas power demand to break May record in heat wave on Friday. And we spoke a little bit about this when we talked about, the hash rate and how that's affecting Bitcoin mining difficulty, because, the miners in Texas have power sharing agreements, load balancing agreements with the grid in Texas, with ERCOT. And of course, it was really hot this weekend. It was darn near 100 degrees in Georgia, and it was about 14 degrees above what the normal temperature would be here in Florida. The article goes on to say, power use in Texas was on track to break the record for the month of May on Friday for the second time this week, and could top that again over the Memorial Day weekend as homes and businesses crank up air conditioners to escape a heat wave. The Electric Reliability Council of Texas, ERCOT, which operates most of the state's power grid for 27 million customers, said the system was currently operating normal, with enough supply available to meet the expected demand all week. The article goes on to mention that they're expecting 75,296 megawatts of electricity demand. And of course, they had an all-time peak of 85,508 megawatts in August of last year. And they managed to get through it. Whereas a couple years ago, remember, they had the ice storm in Texas, and then they had a heat wave in the summer, and they had brownouts. Or in the case of the ice storm, they had no power for like 10 days. I had a relative in Allen, Texas, a suburb of Dallas. It was freezing, and they were shivering in their homes, and they had no way to heat their home because they had no electricity, and everything was freezing in their house. And that didn't happen when they set an all-time record just last August. And the reason it did not happen was because of Bitcoin mining. The Bitcoin miners like Riot have agreed, and they have systems in place where they can actually get paid for shutting off their miners when there's times of high demand, to allow people that use that electricity in their homes, to allow businesses to use that electricity, and to prevent those rolling blackouts. So, and we didn't have rolling blackouts in Texas this weekend, all because of those load sharing agreements. So, they say Bitcoin fixes the money, Bitcoin fixes the world. Bitcoin fixed the heat wave. The other big news was the Ethereum ETF. Of course, this is not an Ethereum show, but this does apply to Bitcoin. Of course, we had the SEC come out and approve the Ethereum, or kind of approve the Ethereum ETFs last week. The ETFs are still not cleared to begin trading, but depending who you ask, it's anticipated that the remaining forms will be approved in the next month or so. So it's widely anticipated that these ETFs will begin trading. The anticipated approval was credited with pumping the price of Bitcoin as well as Ethereum, although it's worth noting that even though ETH pumped significantly, it is still below. It still has never retaken its 2021 all-time high, even though Bitcoin smashed its previous all-time high when its ETF was approved. So ETH, even though it pumped, even though there was huge anticipation of this approval of this Ethereum ETF, is continuing to trend in zero in Bitcoin terms. I'm also not 100% convinced the ETH ETFs will actually begin trading, at least not in their current proposed form. The SEC has left themselves a little bit of wiggle room here, indicating that they have issues with ETFs staking the ETH they hold. And this is something that's clearly different. This does not apply to Bitcoin. Bitcoin is proof of work, not proof of stake. There is no Bitcoin staking. And so they have what I believe to be a legitimate reason to say that the court ruling that forced their hand on the Bitcoin ETFs doesn't apply. Of course, with the Bitcoin ETFs, the court ruled that, hey, they'd already approved the Bitcoin futures ETFs, so their logic for denying the spot ETFs was inconsistent. It was capricious and arbitrary, and they were forced basically to approve the Bitcoin ETFs. However, the different thing with the ETH ETFs is that you'll be able to stake the ETH that the ETFs hold. And of course, staking is earning yield on that Bitcoin. And earning yield is an expectation of profit, and earning yield at from the work of others, basically meeting the Howey test as a security, being potentially an unregistered security, something that doesn't apply to Bitcoin ETFs, which means I could see them, the long and the short is I could see them actually denying, approving the concept of Ethereum ETFs, but denying all the individual ETFs over the staking issue. Now, who knows? Most people assume that an ETH ETF will be approved, and that, and if that's the case, it doesn't really matter, because that's apples and oranges. It's ETH, not Bitcoin. I would rather stack and hold my own Bitcoin. I recommend that you take custody of your Bitcoin. Obviously, with the ETFs, you don't actually own the underlying asset. You just own a promise. You have an account with the ETF, with the ETF manager, with BlackRock or whoever, saying that they owe you the profits from a certain amount, a corresponding amount of the underlying asset. In the I'm cautiously optimistic category, there has been much debate about how and when changes should be implemented to the Bitcoin protocol. Remember, there were unintended consequences that we saw when Taproot was enabled, for example. We had the enablement at a discount to spam the Bitcoin core protocol. The people that argue that you could always do things like ordinals and inscriptions with Bitcoin kind of missed the mark, because what you couldn't do is do it for almost free, basically for a huge discount, completely clog up the block space without paying the fees that we have to pay to do an on-chain transaction, because they pay a discounted rate since it's in the witness portion. They don't actually have the data of an actual monetary transaction. So many, including Michael Saylor, have been calling for the ossification of Bitcoin's code, making it more difficult or impossible to change the code, because we don't want to screw things up, right? The one risk to Bitcoin is that they implement a code change and it has an unintended consequence, much like Taproot did, but one that absolutely wrecks Bitcoin, that being potentially the only way that Bitcoin could fail. So the way you prevent it from failing is just don't let people muck with the code. Those on the opposite side have been actively pushing soft forks recently to implement things like check template verify and opcat, etc., stating that if we don't do this, Bitcoin will die, Bitcoin will fail, it's an emergency because of high fees, and because one day, if Bitcoin is used by everyone in the world, there's not enough on-chain ability for everyone in the world to have UTXOs and make transactions. Of course, we saw the high fee narrative completely evaporate in short order, but the scaling issue has remained trickier. Obviously, it's something that won't happen for years and years and years, so people like me say it's something we don't need to address now. However, today, Jeremy Rubin tweeted about a possible novel solution, a possible breakthrough, a possible way to get their cake and eat it too without actually changing the Bitcoin code. Jeremy Rubin tweeted, "Functional encryption enables covenants on Bitcoin without a soft fork. You simply encrypt a covenant opcode circuit containing a particular private key, it's e.g. CTV." And he goes on to basically illustrate in a technical manner how that works. With the equation, basically. But the long and the short of it is, he potentially has a way that we can enable CTV, enable second layer solutions, etc., without actually implementing the forks that they had been pushing. So that just goes to show that we're not in a rush. If it's not broke, don't fix it. For example, there's the 2040 bug where we will have to implement a hard fork to fix it because of a technical issue with the Bitcoin code, but not 2040, 2140. But it's something that's 100 years away. So why rush to fix it when the people that are going to have to deal with it aren't even alive right now? So this is an example of that. If we had rushed to implement check template verify, we would have implemented a soft fork that might have had some unintended consequences. And it turns out we potentially don't even need to. So that's really cool. Speaking of Bitcoin ETFs, back on that track, Zero Hedge reported, tweeting, "It's official, with a massive inflow of 101.9 million, IBIT is now the largest Bitcoin ETF in the world, surpassing GBTC. We have a flippening." And yes, as futures dump, both IBIT and FBTC aggressively bought even the smallest dips. So previously, Grayscale Bitcoin Trust had been the largest. Grayscale had been the largest ETF because they had converted Grayscale Bitcoin Trust, which was the only vehicle like that to quote unquote gain Bitcoin exposure. And of course, they have the highest fees. And people were, before that even, were stuck in Grayscale Bitcoin. They had no mechanism for redeeming. There were lawsuits over that, in fact. So as soon as the trust became converted to an ETF and they were able to sell, they were able to dump it, they did. And we saw, $1 billion or so worth of outflow. And there was a lot of Bitcoin to dump. And we've now gotten to the point where BlackRock now holds more Bitcoin than Grayscale. And the biggest reason that's important is because eventually there will be no more Grayscale Bitcoin to dump. All of the other ETFs in general have been soaking up Bitcoin. So even the days where we've had outflows in general, it was always because Grayscale was dumping. And the days of Grayscale being able to dump are going away. More positive news. Another company has joined the ranks of MicroStrategy. You may have heard that 2 days ago, Semler Scientific announced that they have begun acquiring Bitcoin. PRN Newswire, for example, ran the headline, "Semler Scientific announces Bitcoin treasury strategy." A pioneer in developing the treasury, blah, blah, blah. They basically announced that Semler Scientific announced that it has purchased 581 Bitcoin for an aggregate amount of $40 billion. And that's small potatoes compared to MicroStrategy, for example, with billions of dollars of the Bitcoin. But it is another sign of looming corporate FOMO, which I think will kick off in excess when Bitcoin goes on its face-melting bull run later this year, if history repeats. And we're already seeing it with companies like Semler Scientific jumping on the bandwagon. And other companies are going to notice. They're going to notice MicroStrategy and now Semler Scientific when they have huge returns on their Bitcoin treasury, when Bitcoin 2x's, 3x's, or 10x's, just in the next 4 years, let alone what's going to happen, with the 2028 halving or the 2032 halving, as Bitcoin continues to go up into the right on its way to hyper-Bitcoinization. I guess finally, Stacey Herbert tweeted out today, "Jack Dorsey-backed Ocean Mining establishes global headquarters in El Salvador. Every Bitcoin company needs Bitcoin on its balance sheet and headquarters in a Bitcoin country. Welcome to El Salvador." So a little bit more good news in the Bitcoin world, because speaking of FOMO, we just talked about corporate FOMO. People are going to notice, they are noticing, but people are going to notice what's going on in El Salvador and not be able to ignore it. And other countries will eventually FOMO in behind El Salvador. And this is just another win for El Salvador, with another big Bitcoin company moving their headquarters to El Salvador. So congratulations to Ocean Mining. Congratulations to El Salvador. Okay, on to what makes today and every Wednesday special, DCA Wednesday. And if you're just following us, if this is the first time you've listened to this podcast and you don't know what DCA is DCA short for dollar cost averaging, and dollar cost averaging is an investment strategy where you invest your money in equal portions at regular intervals, regardless of price. For example, this will be our 149th stack. We started stacking all the way back on July 28th, 2021. And we started investing just $20 a week because I wanted to keep it simple. I wanted to invest an amount that anyone listening to this podcast, for the most part, should be able to afford weekly. So our equal portion was $20. Obviously, our regular interval is weekly on Wednesdays. And so far, we've stacked 148 times. converting a total of $2,960 into a stack of 9,368,335 sats. And we've done so at an average purchase price of $31,595.80. And despite the fact that Bitcoin has been significantly higher than that, it's significantly higher right now. We started buying right between the two peaks in the last halving bull run, but then we bought all the way down, and we're buying all the way up. But as a result, we bought in a price that is substantially cheaper than what the current price of Bitcoin is. And we're going to add to today's stack once again using the handy dandy Cash App. And I'm running up against a hard deadline, so I'm going to speed things along here. But basically, Cash App is not a sponsor of the show. I just enjoy using it. And I've already added $20 to Cash App. So it's just a matter of tapping on Bitcoin, tapping buy, manually entering $20 because that's not one of the options again this time. But you can invest as little as $1 worth of US dollar into Bitcoin. You can set whatever amount you want. That's a you do you thing. Tap and confirm, and boom! Just like that, we purchased another 28,903 sats. So because the price has dipped a little bit, we've managed to scoop up an extra 800 or 700, almost 800 sats. And that brings our total stack to 9,397,238 sats, so just under 9.4 million sats. It did raise our average purchase price by about $115. So our average cost basis is now $31,711.45, but that is not too shabby. All right, before I go, I want to ask those of you listening to help support the podcast just by simply feeding the algorithm monster. The simplest way you can support the podcast is, for example, following our Twitter, our podcast Twitter at BTC Bulletin Pod. The more followers we get, the more people are likely to see our tweets, and therefore the more people who are likely to listen to the podcast, learn about dollar cost averaging, learn about Bitcoin, take that orange pill, and help change their lives for the better. The other way you can do so, of course, is by reviewing this podcast, by rating this podcast, depending on how you're listening to the podcast, what platform you're listening to. You can either review, like, subscribe, rate the podcast, etc. All of that feeds the algorithm monster, which means more people are likely to see this podcast featured in their feed, and therefore they're more likely to listen, and we're hopefully likely to orange pill more people. Most importantly, though, I'd like to hear your feedback. I'd like to know what you think about the podcast. I'd like to know where you're listening from. So if you do follow us on Twitter at BTC Bulletin Pod, send me a DM and let me know what you think. You can also email me at bitcoinbulletin@protonmail.com. But either way, do not forget to join us next Wednesday and every Wednesday while we grow this stack together, just $20 at a time. But either way, keep on stacking those sats, you sexy sat stackers.